SCHD is my largest dividend investment, and I'm buying it every day the markets are open. The goal is to get $15 in the SCHD 365 days a year. That's because based on what it's already done, the math says this is the least amount we need to invest in order to get a yearly dividend above $59,384 before we're 900 years old. The reason why $59,384 is important is because that is the average income for a salaried person in the United States for Q4 of 2023. And in this video, I'll give you the historical performance of SCHD. I'll show you the math on why $15 a day works. We'll talk about how the fund works in detail, why SCHD is so popular among dividend investors, how likely is it that the historical performance will match future performance, what the downsides of SCHD are, and finally ways we can counter those downsides so we can maximize our chances of one day living off of our investments. With all that being said, I'm not a financial advisor. I'm not qualified to give you that sort of information, but you're more than welcome to learn from the research I'm doing for myself. So think of this as financial show and tell with me, Raj B. If you're watching this video, you're probably like me. You know investing is something you need to do, not because we want sports cars and yacht parties. Don't get me wrong, those would be nice too, but rather because our parents are getting older and taking care of them and all the other people we care about is at the top of our priority list. So before we YOLO every dollar we earn into NVIDIA, throw it into a random meme coin with the hope of a 100x return, or just generally take massive risks, let's take a look at SCHD, which is not nearly as exciting, but it has a fantastic history of returns and can be a stable base that we can build off. The Schwab US Dividend Equity ETF was first available on October 20th, 2011. So for context, SCHD survived and thrived through major global events that caused a lot of uncertainty in financial markets. Things like Brexit, hyperinflation in Venezuela, and all the events of 2020 and 2021 that of course are affecting us now. In the past 10 years, it's up 125%. Its dividend yield is 3.39%. It's been paying a consistent dividend, but the crazy thing is that the dividend has been growing for 12 consecutive years at a rate of 11% for the past 10 years. Plugging this data into a dividend calculator, assuming we're reinvesting the dividends, starting with $1,000 invested and investing $15 a day, this gets us to $64,722.07 in annual dividends, or $5,393.50 a month after 32 years of investing. So as well as SCHD has done, 32 years is still a long time, and we know there's plenty of other options to invest in. Some of them are up hundreds of percentage points in just the past year alone. Why would anyone choose a lower performing asset? It's like you're choosing to make less money. Well, that's because generally these higher performing assets carry more risk, and nobody likes to lose money. If you're a dividend investor or someone who invests with the intention of collecting a dividend from a company to either reinvest or take as a cash payment, and you're looking for something reliable long-term, SCHD offers a ton of value. How SCHD works is based on a simple goal, which is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. In order to do this, the fund managers invest in stocks that are included in the index, which is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends. Now, they're selected for fundamental strength relative to their peers based on financial ratios. And for a stock to be an SCHD, it has to have had a 10-year history of paying a dividend, have a market cap above $500 million, and meet liquidity requirements. Once these filters are applied, only the highest dividend yielding stocks based on 4 fundamentals-based criteria are allowed in SCHD. This is based on the cash flow to total debt, return on equity, dividend yield, and the 5-year dividend growth rate. To protect against concentration risk, no single stock can represent more than 4% of the index, and no single sector can represent more than 25% of the index. And this is measured when SCHD was first created, at the time of reconstruction and rebalancing. The index is reviewed annually and rebalanced quarterly, which means every year the stocks held can change and the ratios of the existing holdings are adjusted every quarter. So the stock criteria, based on the strategy used by SCHD, led to the stock picks for the fund, which led to the results we see today. But to be clear, there's more benefits here for SCHD compared to a lot of other types of investing, including other styles of dividend investing. I personally love the fact that I don't have to worry about any one company going out of business or cutting its dividend. Because SCHD consists of tons of screen dividend stocks that select for stability, I get to benefit from a growing dividend, and the fund overall has been growing in value as well. I also love the fact that this selection process and management of the fund's positions are done without any input from me as an investor. And all this is being given to us for a very low expense ratio of 0.06%. Now, of course, we can't go back in time and invest in SCHD or Bitcoin or any other asset for that matter, and we can't see the future. But we can see how SCHD performed historically side by side against the overall market. Since we're looking backwards, we can add context to what was going on at the time. So compared to the S&P 500 for the past 10 years, SCHD has been outperforming in terms of total returns. This accounts for dividends paid out. Depending on your time frame, there are periods where the S&P 500 outperforms SCHD given its holdings, but why SCHD has the edge in the 10-year is because it held up better during 2022 and 2023 when the markets were a little shaky. So based on this alone, SCHD can be seen as the more defensive option of the two, and assuming the US markets continue to do well in the future, SCHD should see similar results. Now, SCHD is not perfect. A perfect investment does not exist, and we already went over the fact that SCHD does not go up in a straight line forever. There were periods, if you zoom in on the chart, where we can see price drops. One of the things we have to know if we're planning on putting money into this, especially long-term, especially if we're planning on using this as a reliable source of funds in the future, are the weaknesses of the investment. If we know the downsides, we know the risk, and we're more likely to hold given we know what to expect. So even though SCHD generally pays a tax-friendly dividend, SCHD has no tech exposure, no real estate exposure, no international exposure. It has a low yield compared to some other dividend-paying investments, and it pays the dividend quarterly. So now more practically, if we were to find solutions to these problems, we can then build a well-rounded portfolio and be protected from market risk, but also be able to capitalize on market opportunities. So if we wanted to get more tech exposure in our portfolio, an ETF like QQQ would do great, or if you're feeling a bit riskier, buying individual tech stocks like Apple, Google, Nvidia, whatever works for you. As far as real estate, you could buy a physical property or invest in a real estate ETF. Individual stocks also work here as well, depending on your risk tolerance. An international ETF would cover your international positions, and you can tailor this to your preference. If you wanted to invest in emerging markets or already developed markets, that's up to you. And to address getting a higher yield than a monthly dividend, I'm personally using covered call ETFs to make an extra $100 a month with just $6,537.40 invested. That's 1.5% a month, or a massive 18% dividend for the year. More info is in this video here on your screen now, and if it's not there, there'll be a link in the description below. I'll see you over there.